In today's video, we're going to be breaking down some of the most important tax and retirement changes with the One Big Beautiful Bill Act, also known as OBBBA. If you're working, nearing retirement, or actively participating in your 401k, these updates could directly impact how you plan moving forward. Let's walk through some of the really important changes. First, we have tax rate extensions. One of the biggest headlines is that many of the income tax rates and brackets have become permanent. Instead of wondering whether brackets are going to jump in a few years, we now have some more clarity. This makes strategies like Roth conversions and long-term withdrawal planning a little bit easier to map out. 2. The higher standard deduction and senior deduction. The current standard deduction is remaining elevated, and there's now an additional senior deduction available for taxpayers that are 65 and older. For 2025, it's $6,000 per person or $12,000 for couples, subject to income limits. This gives many retirees additional tax relief, even if they don't itemize their deductions. This means more income shielded from tax each year. 3. We have a SALT, or state and local taxes deduction cap increase. The state and local tax deduction has been increased temporarily up to $40,000. This number used to be $10,000, so this is a significant jump. 4. We have a charitable deduction for non-itemizers. Taxpayers who do not itemize will still be able to deduct their charitable contributions, up to a set limit. This is $1,000 for a single filer and $2,000 for a couple. This expands the tax benefits of giving and makes planning available to more individuals. 5. We have expanded flexibility for the 529s and HSAs. 529 plans now have expanded flexibility for education expenses. Health savings accounts have been adjusted to have more broad eligibility and more planning options. 6. We have mandatory Roth catch-up contributions. This is a huge retirement planning change. If you are age 50 and older and making catch-up contributions to your 401k, these catch-up contributions may now need to be designated as Roth rather than pre-tax if your income exceeds certain thresholds. What this means is you will not receive an extra deduction on those catch-up dollars. These contributions are made after tax, but for qualified withdrawals in retirement, those will be completely tax-free. Now, previously, high earners could designate whether they wanted their catch-up contributions to be pre-tax or Roth. For many high-income earners, Roth is now the mandatory selection. So you might be saying, what does this all mean? You may owe slightly more in taxes today, but you're building more tax-free income for the future. If you are in your 50s or 60s aggressively saving for retirement, this will directly impact your contributions on your paycheck. So what should you do now? Here are a few smart next steps. Make sure you review how your retirement contributions are set up. And more importantly, understand if your catch-up contributions are going to be Roth. This is a great opportunity to revisit your current tax strategy while rates are somewhat predictable. Coordinate withdrawals, Roth conversions, and long-term income planning. And don't let these changes happen passively. It's a great idea to be intentional. If you would like guidance in executing or coordinating anything I've mentioned in this video, please don't hesitate to book a meeting in my bio. So overall, OBBBA has a lot of changes that affects a wide range of individuals. And this is a great time to adjust your plan strategically due to some of these changes. When rules around your deductions, contributions, and retirement income change, that's a great time to revisit your current plan. If you like videos like this and would like to continue learning more, please consider liking and subscribing. Thank you for watching and take care.